if the US wanted to revalue gold, yeah, in theory, you could print dollars and buy gold. And I would think the gold price would go up a lot if they did that. It would amount to the US devaluing its debt against gold, which is what needs to happen. Like the whole world knows this is going to happen. That's the reason central banks have been buying gold and not treasuries for 11 years. That's one way they could conceivably revalue gold higher to capture that upside. Because look, at 39% tariff on gold, if it went through, gold went to $4,500 from 3,400 at at the 39% tariff rate. Now you're talking $1.2 trillion, up from 880 billion.
The fiscal position of the United States has reached a point where traditional measures are no longer enough to contain the storm. With deficits climbing, interest expenses swallowing a larger share of tax receipts, and foreign investors growing wary of long-term treasuries, the pressure on Washington is mounting. The U.S. is running out of options, and gold may be the lever they eventually have to pull. What he outlines is not a speculative theory. It's embedded in the numbers and in the very accounting framework of the Federal Reserve itself. Luke Gromen, founder of Forest for the Trees, has spent decades studying the intersection of global debt, currencies, and commodities. He argues that the U.S. could revalue gold to ease its fiscal bind, either through a subtle introduction of gold-linked Treasury bonds, or by revaluing official gold reserves directly on the Fed's balance sheet. Either path would enable the government to reduce borrowing costs while bolstering confidence in its debt. At today's levels, a revaluation to market prices could instantly generate nearly $1 trillion for the Treasury without issuing more debt. This move could stabilize the long end of the yield curve. But this is not a sign of strength. It's a recognition that the U.S. is backed into a corner. With actual interest expenses already exceeding 100% of federal receipts, policymakers have little room left. Cutting entitlements or veterans' benefits is politically impossible, and pushing the Fed to slash rates only delays the reckoning. That leaves gold revaluation as one of the few tools left to manage the crisis. Now, let's get into Luke Gromen's complete breakdown. Before we continue, please subscribe to our channel and hit the bell icon so you don't miss our following analysis.
I think that's one way to do it. I think there's kind of two ways that gold could be brought, to bear, I guess, if you will, on the Treasury market. The one is the way that Judy Shelton has laid out, and I think she's brilliant and has done a good job of highlighting that, which is essentially, I think, the tourist way to think about that is the United States has too much debt. And that is beginning to increase term premiums on long-term debt. In other words, the market is beginning to demand more interest from the United States because of the levels of debt. The market is not worried about the U.S. defaulting, but the world is doing the math and going, the Americans cannot pay this back mathematically unless they inflate it away, unless they keep growth well above rates, in which case I'm going to lose real purchasing power by holding a long-term American Treasury bond. And so you're beginning to see those concerns reflected in yields at the long end of the Treasury curve. One way gold can fix that is, you think about it, a Treasury bond, every bond has two components of risk, right? So you've got default risk and or credit risk, and you've got inflation risk. Well, there's no default risk to an American Treasury bond. They owe it in dollars, they have a printing press, they can always print you back the dollars. The dollars might be worthless, but you're always going to get your dollars back. So by introducing a gold kicker, right, some of the gold bonds that Judy Shelton has talked about in the past, you eliminate or significantly reduce at least the inflation risk of a long-term Treasury bond. So, and by doing that, you can reduce interest rates, the borrowing rate of long-term, right? So I might not be interested as a foreigner at buying a 10-year U.S. Treasury yielding 4.25% today, because I look at the math and I look at the fiscal numbers and I say, you know what? The Americans are going to have to inflate this away. This is not a good deal for me. And a lot of foreign entities have been doing that exact math and arriving at that exact decision. They've been buying gold instead. Now, the Americans say, look, we're going to offer on every $1,000 face value Treasury bond $100 of gold valued at $4,000 per ounce. And then, it's convertible here at these intervals, however you want to structure that. Then all of a sudden, the gold side of it completely takes away the inflation risk. And now I might say, oh, you know what, 4.25%, I'll buy that bond. In fact, I'll buy it all the way down to 3% or 2.5%. I'll be happy to buy a 2.5% US Treasury bond if 10% of it is convertible into gold at, say, $3,500 or $4,000 an ounce, whatever. Practically speaking, it would have to be a higher price given the level of debt to kind of cover to make to make it work. But that's one way gold can be brought to bear to lower the borrowing costs of the United States. The other way is a bit more all at once and blunt force. But if you look at the Financial Accounting Manual for Federal Reserve Banks, it's a publicly available document, Section 2.10. It provides for the U.S. Treasury Secretary to instruct the Fed to revalue the gold from $42 per ounce, where it is held, statutory rate on the U.S. balance sheet, on the Fed's balance sheet, up to the market price. Well, today it trades at $3,400 an ounce, roughly. That's at today's price is about $876 billion of gain that would mathematically just get deposited into the Treasury general account. You wouldn't have to sell the gold. There would be no transaction. It is simply an accounting entry. It's basically Treasury creating money using the gold without having an offsetting increase in debt, as is usually the case with money creation. And then Besant would be able to take that and say, look, I got $876 billion more in the Treasury general account. I'm going to curtail issuance at the long end for the next 2 years. And so despite some of the inflationary policies we've been talking about, and reshoring is definitely going to be inflationary over time in a very real way, you could actually anesthetize, as I've called it, the long end of the Treasury curve. You could keep 10 and 20 and 30-year Treasury yields from rising too much, simply because you wouldn't need to issue barely any if you have this Treasury general account to fund your operations for that part of the curve instead. And obviously, the U.S. has 261 million ounces of gold, roughly. Every $4,000 per ounce in the price of gold is about $1 trillion that would get deposited into the Treasury general account every time you do this trick. And so that's a more blunt force way that you could bring gold to bear to reduce the borrowing costs of the U.S. But either way, regardless of what I think, the U.S. fiscal situation is getting very, very acute. I think they're going to have to do something along these lines over the next 9 to 12 to 18 months. It's just, there's no other options. I think it's going to have to happen, sooner rather than later, unfortunately. And the reason I say that is the latest July deficit statement just came out, right? Yesterday. If something we track very closely is what we call true interest expense as a percentage of U.S. total receipts. Treasury receipts. And what we count in that is interest, gross interest, entitlement payments, and Veterans Affairs. These are the interest of this country and the interest-like obligations of the off-balance sheet liabilities of this country relative to the amount of receipts. And, they're running year-to-date through the third quarter at about 101% of receipts, with receipts at all-time highs, with job growth good, with stocks at near all-time highs. And in July, that percentage was 132%. So when you think about interest and the interest-like obligations at 100 to 130% of your receipts, and your receipts are at all-time highs, you're in an emergency. You have a choice. You either start looking to cut one of those expenditures, right? Can we cut entitlements? No. Can we cut Veterans Affairs? No. Can we cut interest? Well, they're sure beating the heck out of Powell to cut interest. Secretary Besant came out yesterday, said they need to cut 50 basis points immediately. Well, I bet he's saying that. I would be saying the same thing too, because the easiest thing to cut is the $1.5 trillion they're spending annually on interest, which is, almost 30% of receipts pro forma. They need something. They are in a position where they are up against the wall. And heaven forbid, if stocks fall, that total interest expense goes up rapidly. If the economy, if job growth slows or even falls, heaven forbid, same thing. So this to me is sort of the most acute dynamic when you say, when are they going to have to do it? I think eventually they're going to have to do it. But the fiscal situation of the United States, particularly when you're talking about some of the strategic things they're looking to do in terms of reshoring, et cetera, which are inflationary, which would all else equal put upward pressure on interest rates, all else equal, put upward pressure on true interest expenses as a percent of receipts. I don't think they want to do it yet. And so I think that's why we're seeing some of the other things first, right? Let's pound on Powell. Let's try to pressure the Fed to cut rates. Bessent 2 weeks ago coming out and saying we're going to upsize Treasury buybacks and we're going to significantly increase the buybacks done at the long end. That's basically Treasury QE twist, right? Like we're going to try to shift stuff on the margin out of the long end into the short end, which are much more liquid markets, et cetera. But you can see them taking steps that suggest they are under pressure from a fiscal standpoint, which is exactly what the math suggests. So I think they're ultimately, I think they would rather do some other things first. But I think they're ultimately going to have to do that. And I think it's a good thing for the U.S. I think it gives them a tremendous amount of fiscal flexibility, particularly if they revalue the gold up and then that money goes into the TGA. Now, all of a sudden, Bessent has a lot of flexibility with respect to terming out debt and the financial markets, et cetera.
The surge of gold imports into the United States following Trump's election was more than a statistical anomaly. It exposed the shifting foundation beneath the global monetary order. Luke Gromen points out that the volumes were so large they temporarily turned U.S. GDP negative, raising the question, who was buying? While the buyers remain unclear, the implications are not. If Washington were quietly building reserves, it would represent the first step toward re-anchoring U.S. debt against gold, a move that central banks worldwide have been anticipating for over a decade. Gromen stresses that central banks began the pivot away from treasuries in 2011, steadily adding gold to their balance sheets. The United States has been the last to acknowledge this reality, but the signals are growing stronger. Even Trump's short-lived proposal of a 39% gold tariff underscored how policy could ignite a massive repricing, forcing global markets to revalue gold higher and weaken the dollar in the process. Such a move would not only devalue U.S. debt, but also restore competitiveness by pushing the dollar lower against the yuan and the euro. In effect, gold, not treasuries, would become the neutral reserve asset underpinning the system. Let's get back to the interview.
We saw very large imports of gold into this country in the first quarter of the year, starting shortly after Trump won. There was so much gold imported into this country in the first quarter that it actually mathematically turned GDP negative for a couple of months, pretty significantly negative. So somebody was importing a significant amount of gold into this country in the first quarter. Who could that be? I don't know. To me, I think it's possible that at least some of that was the U.S. government or some sort of Treasury proxy. But setting aside the speculation, if the U.S. wanted to revalue gold, yeah, in theory, you could print dollars and buy gold. And I would think the gold price would go up a lot if they did that. It would amount to the U.S. devaluing its debt against gold, which is what needs to happen. Like the whole world knows this is going to happen. That's the reason central banks have been buying gold and not treasuries for 11 years. So sort of like the last thing keeping us from this is we don't want to give up that sort of, make that statement of, well, gold is now the primary reserve asset, not treasuries anymore. But the fact is, by their actions, central banks began making that declaration 11 years ago. And so we're kind of the last ones to give it up. And critically, the Trump administration gets it. The military gets it. It's in our interest. So I think something like that is possible, and it could be done in a more surreptitious way. So when I look last week, when Trump all of a sudden came out and said, I'm going to put tariffs on gold at 39%, I was on vacation. I said, whoa, that's essentially, if you wanted to do that, the disruption that would create to global gold markets would quite possibly, if not quite likely, trigger a massive short squeeze in unallocated and gold markets around the world, much higher. Would we do it that way so that, if
but
you put a 39...
he subsequently walked that back with just a very
right, exactly.
clear post on X.
Of course.
We will not put tariff on the gold. So what was that about?
Yep. I don't know. Did he make a mistake? Was he told you can't do this? Was that simply a test of the emergency broadcasting system as we used to watch, on Saturday morning cartoons of like, hey, we're going to do this at some point. don't get too far over your skis short in gold, get on sides. I don't know. I can make the case either way. That's one way they could conceivably revalue gold higher to capture that upside, because look, a 39% tariff on gold, if it went through, gold went to $4,500 from 3,400 at the 39% tariff rate. Now you're talking $1.2 trillion, up from 880 billion. By moving gold into a neutral reserve asset where the world is on a net basis reserving gold that floats in every currency, essentially everyone's going to bid the biggest portion of deficits in local currency terms. They're going to bid for gold. Now, who's got the biggest deficits? There's going to be a few yuan bidding for gold. There's going to be a few euro bidding for gold, because they each run, the Chinese run a capital current account surplus. The Europeans are roughly a flat capital account. The Americans run huge deficits. So there's going to be a lot of dollars bidding for gold in that situation. And so the price of gold will rise a lot in dollars, a lot more than it does in yuan, yen, euro. And as that happens through the gold pivot, through the gold reference point, as a World Bank president, Robert Zoellick, called it 15 years ago, you are going to end up with a weaker dollar relative to yuan, yen, euro, which is exactly what the Trump administration has been trying to do for 1+ terms already. It's what the U.S. has been trying to get more competitive, even under the Biden administration. We want to get more competitive with Chinese goods. We want the Chinese to strengthen their currency against the dollar. This does all those things through the gold pivot. Dollar gold goes up a lot. Yuan gold goes up less. And we end up with a weaker dollar versus the Chinese yuan, while maintaining sort of the dominance of the dollar systems, the unit of account, the medium of exchange that we like, and quite frankly the world likes, and it allows us to play to our strengths around rule of law and those types of things. There's obviously a multi-century tradition of Anglo-American case law and et cetera around commerce, letters of exchange, global trade, et cetera, that I think a lot of the world wants to keep. It's just that this store of value part of it is just it's not in our interest anymore. It's not in anybody's interest anymore. And that's why I think the world is, by agreement from each's enlightened self-interest, arriving, at least for now, at reserving a lot more gold and not reserving treasuries on net anymore. Technically, for the dollars to be a reserve currency, you got to be reserving it. And I just said central banks stopped reserving it 11 years ago, right? They're reserving gold.
Well, I guess we're phrasing it somewhere else. Reserving the dollar's sort of prominence on the global stage. I get the reserve currency with a neutral reserve asset, but sort of maintaining dollar dominance in one way or another, because that's not something I would think the Trump administration willingly wants to give up, but it is seeing the writing on the wall and taking action. So is there some kind of balance that can be had there, particularly if they lean into the idea of gold?
Yeah, I think ultimately there is. It's a fundamental trade-off, though, right? Like if they want to make a lot more and run smaller deficits by doing so, then the world's going to reserve a lot more gold, and the price of gold's going to go up a lot, and the dollar's going to weaken as a result of that. And I think that's what they're after, is finding some sort of happy medium around, a much weaker dollar, but still a very dominant dollar in payments and in unit of account. And unit of account's pretty easy. I think that's going to be there for a long time. But the payment side in particular, I think, is the one they're worried about losing. I think they're willing to let store of value go. In fact, the things they're doing are encouraging the world to move away from dollars as a store of value. Even if you listen to what Bessent said last weekend, or these Trump trade deals of, hey, we want these countries investing in our country, basically bringing a sovereign wealth fund here, investing in factories that we direct. That's not the deal. The deal was they get to put their money wherever they want. They buy our bonds. That is a reversal of flows, sort of changing the store of value nature of things here. But I think they're okay with that, and they need to be, because if they don't change the store of value, then nothing's going to change, and the U.S. is simply going to continue to be hollowed out, and the national security threat posed by, the hollowed out industrial base is only going to get worse, and it's already pretty bad in terms of our ability to project conventional power against a near peer or peer military around the world. So I think ultimately that's what we're watching is a lot of in real time is chapter and verse, whether it's Trump, whether it's Bessent, whether it's Myron, whether it's Vance, whether it's Trade Representative Jameson Greer this week or last week in the New York Times. They're all saying the same thing, which is we want to get rid of the dollar as global reserve asset, as store of value, and we want to maintain the dominance of the dollar within global payment systems. In so doing, bring the dollar down to a more attractive level for American production to be attractive, reshore our industrial base, and get back on our feet from a standpoint of being able to project conventional military power with our own industrial base without help from the Chinese that we currently can't do. That's sort of the baby they're trying to split. That's the Gordian knot they're trying to cut. There's a lot of executional risk to it. Make no mistake. And that's, I think we have, we're still hearing the echoes of the starting gun going off. Like, this has been decided. We are moving in that direction. You can see this in, the Defense Department's investment in MP Materials on the rare earth side about a month ago. So this is very, very early innings. This is, first couple of pitches of the first inning. A lot of executional risk from here, a lot of political risk, a lot of geopolitical intrigue, and, importantly, like as in combat, the other side gets a say, right? So let's see what China does. Let's see how the Japanese, the Koreans, the Europeans, the Russians react. We are reshoring. We are going to weaken the dollar. And we are going to something else is going to serve as a neutral reserve asset for the global system.
As Luke Gromen highlights, the global monetary system is shifting before our eyes. Central banks stopped reserving treasuries over a decade ago and quietly replaced them with gold. The United States has been slow to admit it, but the signals are undeniable. From massive gold imports to Trump's fleeting 39% tariff proposal that hinted at how easily gold could be repriced higher. Such a shift would weaken the dollar, devalue U.S. debt, and restore competitiveness, while confirming gold as the true neutral reserve asset. This is no longer just theory, it's happening in real time. The U.S. is trying to strike a balance, maintaining the dollar's dominance in payments while acknowledging that its role as a store of value has already shifted to gold. For investors, that means the window for positioning in precious metals may be closing fast. If you found this breakdown insightful, please hit the like button, subscribe, and turn on notifications. Thank you for watching. See you in the following video.